Welcome to the Monopoly Mindset, the podcast where we uncover the strategies to build your real estate portfolio one property at a time.
We're your hosts, Tyler and Tommy, here to share our story of playing real-life Monopoly.
Whether you're just starting out or a seasoned investor, this is your go-to resource for mastering the real estate game.
So grab your board, roll the dice, and let's buy Boardwalk together.
Welcome back to the Monopoly Mindset, episode 18. We got a good episode today. We're going to do some deal analysis for everybody to see kind of how Ty and I would evaluate a deal.
Yeah, today will be very visual. We're going to share our screen a lot, and we chose a couple properties that we're going to analyze, and then just show people how we plug them into our calculator. So if you typically listen, I would recommend for this episode to maybe watch it on YouTube or Spotify.
Yeah, and it's going to be a little bit unique. We haven't really evaluated these deals too much. We found, two on Zillow, and that's going to be the fun, is we're going to take the properties, put them into our calculators and see if they're a good deal or if they're not a good deal, or at least what number would we offer for these properties. So kind of give everybody a peel behind the curtains of how we would analyze a deal.
Yeah, to your point, everything can be a good deal if you get it for the right price. So just because it's listed for X doesn't mean it's necessarily a bad deal. Maybe it is at that price, but doesn't mean it is at what you can get it for. So yeah, with that, let's jump into pass and go. I always let you go first. I'm gonna go first this week. Probably I had a slow and I guess you could say a bad week. I had a bunch of stuff going for me last week. We had an offer on a house with an in-law suite. Didn't get that, which I keep hearing that there's a ton of houses on the market since 2022, and it's becoming a buyer's market, and we offered 10,000 over listing and still didn't get it. So I'm not exactly seeing what the national statistics are showing, but yeah, we're just pushing through. And then I had a lead for a triplex that we were going to try and get off market through seller financing, and I texted the guy because I knew he said he was out of town for a week, so I texted just to follow up and hopefully go see it soon, and he was like, I don't want to sell it anymore. And I was like, can I ask what made you change your mind? And he was just like, I never really wanted to sell it to begin with. And I was like, okay.
Yeah, when you texted me about that, we were both kind of like, well, then why the heck did you list it? And he was listing it by himself, so maybe that was just it. Like, hey, let me put a couple feelers out there and see, but kind of a shitty way to do business.
Yeah, I mean, and he got hits. I was very interested. So it was kind of weird, but he was like, I got your number, and if I change my mind, you'll be the first person I call, blah, blah, blah. So
I saw Brandon Turner post something the other day, and he's like, that property that you have saved and you've talked to that owner for 20 years, and now you see that he's listed it with a realtor.
Yeah.
Yeah, I thought it was pretty funny.
Brandon Turner puts out gold in his Instagram.
Dude, I love him. I've been tuning in a little bit more to his podcast, and just the way that he speaks makes me very interested in real estate and everything else.
I know, not to go off on a tangent, but I'm always I wish he was back on Bigger Pockets, but then I realize he basically has his own Bigger Pockets now. So I actually listened to an episode last week as well. He's I don't know what it is about him. He's just a great person to listen to.
Great communicator, just the way that he speaks, there's a presence or a calmness that you don't necessarily get with a lot of people. And sometimes I've noticed there's certain podcasts that I really want to listen to or I want to and I'm I just can't listen to this one. I can't get through, this guy's not, explaining things correctly. The voice could be wrong. And Brandon Turner just seems to have everything that he says. I'm intrigued by it. I feel I've learned when I listen to him. So I really like his podcast.
Yeah, I think he just comes off as very just genuine, and he's not trying to sell anything. He's just, I mean, obviously he's super successful, but like he just pushes like hard work and like, hey, if you want to become a millionaire in a year, these are the steps you have to take. And like most people that say that, I'm like, yeah, okay, like that's, BS. But like with his stuff, it's like if you actually follow these steps, you probably would become a millionaire in a year. It's just most people aren't going to follow the steps because they're very hard. They're like, send out 100 mailers a day, and it's like his stuff probably would work. Actually, I mean, I guarantee you it would work, right? It's just like a ton of work that he has put in his life. So anyway, that's an aside. But it's called A Better Life podcast if you're interested. Anyway, yeah. So I went from riding high last week to now I'm kind of back to square one with nothing. So I'm gonna get back out there and put in offers. Again, back to like my market, we were gonna go see two houses yesterday, Wednesday, and literally one went on Saturday. My realtor went up to book make the appointment Monday or Tuesday, and they were both off the market already in like 2 days. So or got a offer and accepted. So yeah, things are moving quick still. So yeah, I've realized that buying a primary is even though it's like the financial easiest way to get a rental property, it's freaking difficult. It's like it's a lot easier and honestly a lot more fun at this point to just go look for rental properties and like I I can just run the numbers. I don't need like, you know, I don't have to look for certain features that we're gonna want to live at. So
Yeah, you don't need 2 acres, a white picket fence, a brand new kitchen with enough seating for the family, and 4 bedrooms, and plus you're gonna make money on it. Where typically a primary, you're not necessarily. I mean, your money made is like over the long term, and if you do renovations and upgrades to it, it's not like an investment property where you're looking at making a couple dollars each month in cash flow.
yeah. Yeah, and like I've said in the past, like the biggest struggle for me right now is going from a 3% rate to like a 7% rate, and it's almost making me just say I'm not moving. I'm just gonna buy another rental property instead. And like we're not there yet, but like like I said, like if we buy our same exact house, like we don't upgrade or downgrade, our monthly payment's literally gonna double because one, the purchase price is like 30-40% more, plus the rate is more than double. So it's like a tough pill to swallow. And it probably won't even be able to rent out when we move because the monthly payment will be so high. So
Yeah, I'm with you. When Sarah and I were looking and buying our primary in Florida, it was 3 years ago at this point, and it was miserable. I mean, it was a little bit more during COVID, and we were up north, so we were FaceTiming, but like that boom after COVID, houses were just selling, cash offers over list. I think we ended up having to pay 25K over what our house even appraised for. And we found this one off market, and it still took us like 4 or 5 months of looking at houses like every other day to try and get it to work. So I don't envy you looking for a primary, especially when you have more things that are needs from living in your house for a year or two. You kind of say, okay, I want this in my next house. I want that in my next house. And so I'm sure your list of requirements is making it, and like the area too, like you want to live in a specific area. And yeah, a lot of other people do too. And that's why the houses you're seeing have been sold or they're pending.
yeah, one thing I've noticed that makes it very difficult, like, and a lot of people probably have this issue, but having two dogs that need like a yard and then like a yard that they can't run away into like a busy road. Like we don't want to be on like a main road because I mean, Aria, she's kind of crazy and like sometimes she gets away and run like we don't, and a lot of the houses that we're seeing are like close to like a busy road or like don't have a yard or like anything like that. So that's definitely one thing that I feel like is making it difficult. But
Yeah, in Florida, particular or in Florida, we had an issue with the same thing because we couldn't find any property that had over like half an acre or quarter of an acre. So the house we ended up buying, I think, was like point 0.2 of an acre, and it gave us enough. Our dogs are a little bit smaller than yours, but it gave us enough of a yard to fence in and let them run around. We try to walk them a lot, but the housing lots here are so small, it was pretty difficult to find anything with like even a quarter of an acre, which I feel like is what you want at a bare minimum.
Yeah. I mean, Florida's a lot of like gated communities and like developments, like neighborhoods, and like honestly, we've just never, Danielle and I both, like we'll drive by even like a neighborhood where all the houses are like $1 million and they're super nice, but we've just never been interested in that. Like we see that and I'm like, I would love that house, but like in the middle of nowhere. So, but anyway, and then me and you have our tenants moving out and moving in like 3 days. So did a little work with that, getting them set up on our like rent software and just trying to coordinate like tenants moving out, tenants moving in, without being there and getting this renovation done. So like you said, it'll be a little bit of a stressful week. For me, I only have one turnover and you have like eight. So yeah.
Yeah, so I'll get into my week of pass and go. It's been a little stressful. We've had some kids move out and, they didn't want to pay their security deposit, like their last month's rent. And just like a little bit of back and forth. The property was actually in decent shape, but I feel like it's really a principal thing. Hey, pay your last month's rent, and then we'll give you the security deposit, like once we do an inspection. And for whatever reason, the kids kind of decided, no, we're not paying our last month's rent. So that was just a little awkward to start off the month with. And now we're just kind of going through like exactly what Ty said. We have 7 properties that got people moving out for the most part, and so they're all moving out kind of on Saturday the 30th or 31st, and then they want to move in Sunday on the 1st. So there's like a really quick transition. You got to try and get the properties cleaned and get the people, like, hope the people get out of there. They didn't leave too much stuff behind. Everybody that moves in that first week is always, hey, this house isn't clean enough, or this is wrong and that's wrong. We want this fixed. That wall has a hole in it, or this, we want this painted. There's always going to be like a list of requirements every time there's a turnover. I'm trying to figure out the best way. Like my property manager and I have talked about it in the past. Like, should we space it out a week? Like, hey, you go to, May 24th or May 31st, but then the next lease starts like June 7th or something, to give us like a full week to get some contractors in there. Hasn't been like that big of an issue. Usually the tenants are like, okay, we'll just move our stuff in. You can get the property cleaned. Like sometimes the previous tenants clean it and we don't have to use their security deposit to clean it as well. But overall, it's just a stressful week. Everybody moving in, then you get the parents there and they'll have different requirements that they want to be done at the house. So just looking forward to a stressful weekend. I'll also be at the Misericordia golf outing on Saturday, which is going to be a lot of fun. I'm excited for that. Then Ty and I will be together at a wedding in Wilmington, North Carolina on Sunday, and I fly back late Monday. So overall, a lot of travel this weekend in general, which is going to add to all the text messages I anticipate seeing or getting about this room we want painted, or whatever needs to be done at the properties.
Yeah.
I
Yeah,
also
that's
still
true.
have 70, or Woodlawn is still vacant. We've dropped, I think we listed it at 2,500, then 23. Now we're down to 2,200. The previous owners are still in there until the 13th of June. So it's not like I can get it listed or rented immediately. There's another house that's actually listed for 2,200 that looked pretty good, a little bit better than my house. So we might end up having to drop to 2,000 here in the next couple of weeks. But we'll keep it at 2,200 and see if we can get it. If not, we'll drop it to 2,000 and kind of go from there. I have faith that it's gonna get rented out though. There's not a ton of properties for sale there, so I think that we're gonna be okay finding like a family to get it rented to.
Yeah. Yeah, and then you also had a potential seller financing deal come your way.
Yeah, I know Ty and I talked a couple podcasts ago about sending out some mailers. We haven't gotten there yet. We want to. But one thing I said I was going to do is start talking to realtors and just put the feeler out there. Hey, I know it's a tough market and a lot of people want to sell their houses, but they might not either A, want to list it, they might have tenants in there. So just something I asked or told one of the realtors that I know up in the Dallas area was that if she knew of anybody looking to do seller financing, send them our way, and we'll see if we can make a deal. So she sent us somebody that's looking at potentially doing seller financing. His parameters were a little bit unique. Like in seller financing, there's kind of three different buckets that you can make decisions on, and one is the price, obviously. The other one is the down payment, and the third one is going to be the interest rate. Well, this guy has already given us the price he wants for the property. He's given us the down payment he wants, which was 20%. Usually in seller financing, the perk is to do lower than 20%, but the guy never mentioned an interest rate. So Ty and I were thinking if we got this property for that price and with that 20% down payment, maybe we can offer like a 0% interest rate. And if we do that, we feel like we're at least winning in one of the three buckets. 0% in the market where Ty was just saying everything's at 7%. It's going to be very valuable for us. We still want to get our property manager in there, fully check out the property. It's also got a vacant lot next to it that could be a value, but it's also kind of in some swampy wetlands, and it's right next to a drain and a sewer pipe, and so it's got some issues with it as well. There's probably a reason it hasn't been built on, but I think it's worth checking out the land, seeing if we can build there. That's something Ty and I would love to do, is try to build a property. Plus, if we could get this house with 0% interest, it's not a given. Like, we still have to present some offers and give it to the guy and see what they say. But 0% financing would be a really cool option if it's available.
Yeah. Yeah, and I've heard out of the three, you want to try and get two out of the three. And typically in seller financing, those two things that you're getting in your benefit are interest rate and down payment. And like that's what allows you to offer so much more on the asking price. But yeah, we'll see. I mean,
The last
again,
thing I'm debating on, I haven't talked to Ty too much. I'm sure Ty's going to say absolutely not. Every time I've asked him, he said absolutely not. But I am debating. I have some equity in some properties, two of mine and then two of TDJ's, and so we're debating refinancing from like four. I have 4.5, and then TDJ's got 4.9 interest rates. We're debating refinancing into like 7.2 or 7.3 interest rates just for the opportunity to pull some cash out. We have some repairs to do. TDJ anyway has some repairs to do with some of the properties, especially like with the tenant turnover and getting some of the houses in a little bit better shape. Some of them need painted. And so I look at it as an easier way to get access to some capital to upgrade the properties and hopefully help us get some better rent next year. And then for me, I have a decent amount of equity trapped into two properties, and I'm trying to figure out the best way to access it. If it's doing a refinance, I feel like I can tap the money a little bit quicker versus waiting a year, selling when the tenants move out, and then kind of seeing what that process is like and paying taxes and everything else that goes in with selling it. Like, I think I'll not have a problem renting those properties out. So if I just refi and keep them, doesn't feel like a terrible option for me.
yeah. I mean, based on, I think you just told me the numbers on your personal properties that you sent me, like the pre-disclosure form or like the early estimates. And I mean, like the cool part about real estate is that you can constantly cash out refinance or like do a HELOC and borrow money on your current properties to buy your next one. So like that's obviously, the more you have, the more options you have. It's just in your case, like going from a 4% rate to a 7, like you might not get 4 ever again. And then like the amount of money that you were looking to pull out, I think it was like 50 grand, but you're gonna pay like 15,000 in closing costs. So like I would just run some sort of calculation of like, okay, how much is my cash flow gonna go down because of the rate, and like I'm losing the 15 grand from the refinance and closing cost, and what am I going to do with that 50 grand? Is it going to make me more money than, I'm now losing? But yeah, I mean, it's great to have options, and the more equity you have, obviously, the better you are. And we talk a lot about like return on equity. You don't want to have a ton of equity in a property. It's just, if you got a 3-4% rate on these properties, it's just really tough right now to want to refinance them.
Yeah, and
So
like you said, you kind of live and learn in real estate, and for some reason, 5 years ago, I thought the coolest thing in the world was a portfolio loan. Like you're gonna put three properties on one loan, I only have to pay one mortgage. I thought it was awesome. Now, to your point about trying to find a HELOC, I found people that'll do HELOCs on, rental properties, which is tough, but I found a couple companies, they won't touch my portfolio because I have portfolio loans, and they want to be like the only, like when you have two properties on one loan, it becomes more difficult for them to do a HELOC. So I can't get a HELOC or tap into the equity. So part of me is like, all right, at least if I get rid of that loan with that bank, then it'll give me more flexibility moving forward. There's definitely a loss in cash flow, but getting access to that 50K to fix up, some of TDJ's properties could work out a lot. My scenario is a little bit different. I would still lose out on about $700 of cash flow a month, but I was able to pull out almost like 100 grand. I didn't send you those ones yet.
yeah.
So to me, I'm like, I could definitely buy another property with that amount of money.
Yeah, I mean, to spend 15 grand in closing costs to get access to 100 is a lot more enticing than to spend 15 grand to get access to 50, because like in my mind, you're almost throwing away like 30% right off the bat. But
No, I'm with you. I think in TDJ's example, we need a little bit more money. Just like the company overall, we don't have enough in cash reserves. We've got hit with a couple of things the last year or so that, even if it doesn't make a ton of sense, I think we might lean that way. And then there's also the chance of just doing one. We can do one and pull out, 30 and, pay 7 grand to get 30 versus doing two to get the full 50. So maybe that's a scenario or an option that we go with.
yeah. All right. So, yeah, I think that's it for the week. Let's get into how to analyze a rental property. So this episode is just going to be basically long-term rentals. We're not going to get into short-term or mid-term or anything like that. And we chose two properties. One would be a Burr deal, so that's going to require renovation, refinance, things like that. And then the second one is going to be a duplex, so a multifamily deal. Doesn't really need work. So you're basically just going to buy it with a standard 20% down and see if it cash flows.
And you
So like I
found both of these on Zillow about an hour ago before we started the podcast, right?
Yeah, yeah, and again, so it's not, I just found these real quick. I don't know how good they are yet. We're gonna figure that out together. But so this first one, again, I recommend watching this, the video portion. But so this one is in my county. It's like 20 minutes from where I live. It's actually a foreclosure, and so you can go through the pictures. It needs a lot of work.
First off, I
Um,
love all the shrubs around the house because that's something that typically scares people away. And it's not that hard to rip out landscaping. That's probably the easiest thing. I know we hire people to do a lot, but like as far as ripping out bushes, that's definitely something that you can do by yourself.
Yeah, exactly. These pictures are like perfect because typically homeowners are going to look at, like, people that want to live there are going to look at this and just immediately move on to the next one. One thing that I don't really understand is that it says 480 square feet, which doesn't seem right. It's got to be bigger than that, I think. Um, but so typically, I'll obviously look at the pictures, look at the facts, and then I always go to like the the facts and then show more. I'm typically looking for, like, is there a basement? In this case, no. I always check septic, and actually, wow, this is public, which I'm kind of surprised. So that's perfect. I would prefer public sewer and water. No HOA, etc. And so the most important part about a BRRRR is trying to figure out renovation cost, which you can get a very rough estimate through pictures, but like you're gonna have to go see the property, in my opinion, or like send your contractor out there. That would be the best case, is like send your contractor out there give you a rough estimate, but like most of the time they're not going to do that unless you have a place under contract, which makes sense because it might take you 50 offers to get a deal, right? And they're not going to go see 50 properties until you have it actually under contract. But so with that, we'll go into the calculator. Tommy and I created this calculator ourselves, specifically for Burr. It also has like kind of like a flip estimate as well. So again, the point of this process is not necessarily to figure out if it's a good deal at the purchase price. It's to figure out what purchase price would make it a good deal. So just to start out, we'll just plug in the purchase price here for purchase price, closing costs. We're gonna say 10,000 in my area. And here's kind of the tricky part with this pictures. I mean, it is a small house, so I'm just gonna say 40,000. Again, until you actually see it, you might not know. And then percent down. So this percent down is just going to be on the original purchase. You're going to do a refinance later, but this original purchase, we're going to use hard money, which we've talked about in the past. And you can go ahead and explain hard money as I fill in some more stuff.
Hard money is basically you're going to take out a loan, like kind of like a renovation loan. Somebody's going to give you access to capital. So in this scenario, let's say we're going to get access to $225,000 so that we can take the $175,000 purchase price plus the rehab cost and get all of that money up front so we can pay for the repairs and the renovations. And you're going to be paying interest only on that payment for the first 3 to 6 months as you're looking to do your repairs. And then once those repairs are completed, you're going to take the property to a bank and try to refinance, and then use that refinance money to pay off the hard money loan. That's at least the strategy of the BRRRR.
Yeah. So the next thing we would need to fill in is ARV, and that stands for after repair value. I'm just trying to go back to Zillow.
And so the after repair value, why that becomes important is once you have your money into the property, like the $225,000 with the repair costs, once you go to take it to a bank to refinance, they're going to give you roughly 75 to 80% of what that property would appraise for. So if we put $40,000 of work into the property, then it becomes a matter of like how much does that property then become worth on the open market that like it'll appraise for. And that's what Ty is trying to find now. If it appraises for $250,000, then we'll be able to take out a loan for 75% of that.
Yeah, so basically what I'm doing now is, like you said, looking for comps. So I'll do a filter that's very similar to this property in the same area. So I'm doing sold in the last, I did 90 days, 2 bed, 1 bath, and I did single family only. And there's not a ton in this area. Again, it said 400 square feet. I just can't believe that that's true. But I mean, here's 325, 445. I happen to know that Falston's a more expensive area. Same with Kingsville. But I mean, here's Bel Air, which is the same city.
Can you back it past 90 days, like maybe a little bit further?
Yeah, I mean, you can do that to get more hits. It's just, real estate it changes from month to month, right? So ideally, you want to be as close in proximity as you possibly can and as recent as you possibly can. But depending on how many houses sold, you might have to zoom out and, um, go a little longer. So now we're at like 6 months, and then again, you got to look at the pictures, right? And you're going to assume that your place is going to be in pretty good shape. Like I would say it probably will be in better shape than this property. So honestly, we might want to move that ARV up to 300 because I'm not seeing anything under 300.
Yeah. I mean, that house has more square feet, but like to your point, the square footage is going to be something that's questioned because 400 square feet for a two bed, one bath doesn't seem accurate. It almost seems like it's a one bed, one bath at that level.
Yeah, so I'm actually a little surprised, but we're going to bump this up to 300. And again, like if you're buying with a realtor, that would kind of be his job to tell you that. So the gray boxes are filled in automatically, and percent of ARV spent. The rule of thumb for renovations is you want to be around 70%, maybe 75, and that's basically purchase price plus rehab. That gets you to 215. 215 is 72% of 30,000 or 300,000. And then this, let's kind of plug in. So this is our hard money cost. Now, hard money is expensive. Like you said, it's a renovation loan, and they're going to charge you like a rate 12 to 14. Depending on how much experience you have with flipping, like the more, if you're flipping 10 houses a year, it's less of a risk for them. So they're going to give you better rates. If it's your first deal, you'll probably get like 14%. Length, let's say that the renovation, so you need to renovate, get a tenant in there, have a signed lease before you can go refinance. The renovations will probably only take like 2 to 3 months, but let's just say it's a small house, so we'll just say 4 months. And then points would be basically hard money will charge like 2% flat fee on the total amount borrowed. So we're gonna say 2 points. And so this tells you that you're gonna owe them 3,600 at closing. Holding costs is the interest over the 4 months, and so the 14% at like 300,000. And then this kind of shows you like if you use hard money, you're gonna spend 48,000 out of pocket. You're gonna spend another 8,400 in those 4 months, and again, you don't have any income coming in, so out of pocket, you're gonna spend 57,000. However, one of the perks of hard money is that you're only putting 20% down of the purchase price, which would be the 175. They will fund the entire rehab for you. So you can see here that if you were to just buy this place 20% down and then pay for the rehab yourself, you're going to be spending around 85,000. Whereas with hard money at closing, you're only going to be spending 48. All right, do you see anything that I'm missing?
No, I mean, the only thing I was going to say is I mean, usually the numbers don't work when you're buying it at list price, right? And so if we're going to get the property from 175 to $300,000 appraisal, maybe the rehab could get bumped up to like 50 or 60, and maybe we try to take something off the purchase price.
Yeah, again, like it's very hard to tell. You might get in there and it is a one bed. I've noticed, especially with foreclosures, they don't even go to the property. So the information on Zillow is always incorrect. So again, it's really hard to judge just based on pictures. But so then basically the last step is to try and figure out what you're gonna get for rent. Which again, you're gonna go back to Zillow, you're gonna switch to rent. I'm doing exact match. You don't necessarily have to do that. And then this one, I am going to allow probably townhomes.
Nothing.
Yeah, which could be a really good sign, right? There's a high demand and not a lot of supply. Ton of townhomes. And then typically I'm going to go low to high. I don't know why, but I'm just always going to assume that I'm not going to get the highest rent. Um, probably somewhere in the middle. And being a single family, I'm guessing it's going to get more than a condo. So again, you want to compare pictures. So this place looks probably similar. Like if we renovated this place, we would probably do like LVP flooring, probably like a similar style. And then
This
one
looks
really
like a
important,
duplex, though, no?
yep.
So I think sometimes if you have a single family, it's worth a little bit more than a duplex.
Yeah, and it had a half acre. And this place is also small. Now, I'm assuming that the place we're talking about is more than, again, 400 square feet. 800 sounds more reasonable, but I mean, I don't know. One thing to look at when you're looking at rental comps is go down here. How long has it been on Zillow and how many contacts? And then a lot of places will say applications as well. So, like, that'll tell you, like, oh, is this place like overpriced? Are they actually going to get that? If you go to, like, let's see, typically high to low. I mean, this place is pretty expensive. See, they have 0 applications for almost 3.5 months. So it's like, okay, you're not getting 2,400. So don't run your numbers on 2,400.
Yeah. I think 1,700 seems reasonable.
Yeah, I mean, let's see. Here's a 2-bed, 2-bath, another condo, but they have 2 applications, 5 contacts. So yeah, we'll go with 1,700. Um,
You want me to
Mortgage.
calculate that? Or do you got it?
Yeah, go ahead. I mean, in this scenario, because we're now looking at like after you refinance, you're gonna want to plug in those numbers for
Yeah.
300,000.
At 300,000 with 20% down, right?
Yeah, we have a spot in there. So this LTV is going to be when you refinance, what is the loan to value that the bank offers? Again, I hear a lot of people saying 80%, but that was probably pre-COVID. Now I'm hearing a lot of 75%. So we're going to say 75, meaning we leave in 25%. So here it tells you, okay, our loan is for 225. We have 75,000 in equity left in, and we created 65,000 in equity.
And Ty said that we built this calculator. Ty built this calculator 100%, and it's phenomenal. He did a great job.
I appreciate it. So let's go here. Rental properties, you're going to get higher than current like owner occupied loan, especially if you go DSCR. So we'll say 7.5. And here's where it's tricky because the equity portion works, but the monthly payments 2,000. Estimated monthly payment. That does include taxes, insurance. So we're going to say 2,000. Which, like, right off the bat,
Yeah, you got the taxes and insurance there, but I see what you're saying. Sometimes it's easier just to take it off of Zillow and include it there versus, yeah.
yeah. So then vacancy, repairs, and capex. Again, you just factor these things in, and that's 15% total. And so this is showing you with property management, you're going to lose $875 a month. Without property management, you're going to lose $700 a month. Again, you'll actually be losing 300, but then once you add in all these things that they're not going to happen every month, but they're going to be big expenses, say like every year, every other year. This is kind of a more accurate.
One
Change.
positive thing with a BRRRR is typically, I mean, vacancy you still have to account for, but repairs and capex, you hope once you repair $50,000 into a property that you're not going to have as many capex issues or even repairs really because you just renovated everything. But, even with that, yeah, you're still $400 at least in the hole each month with this scenario.
Yeah. And then this is kind of the power of a BRRRR. So when we go to refinance, because we have a ton of equity, we're going to be able to pull out $25,000. And this is like assuming that you're paying closing costs again. So you're paying this $10,000 on the original purchase, and then you're paying the $10,000 on the closing costs. But basically, that's taking like 225, which is your current loan, and then you're paying off the existing loan, the hard money, and then you get to keep whatever's left over. And then that tells you that you're leaving in $32,000 cash. So the purchase price honestly is pretty fair. This one's just hard because if you do refinance at 300, the rent doesn't really support that. And so like the only thing that you could do is refinance at a lower ARV and not pull out as much as you possibly can.
Like maybe a 70% loan to value, or
Yeah, I mean that's again, you're not going to be able to. You're going to leave in more, but your monthly payment, let's say, it would go down to 1,800. I don't know. So I mean this scenario is tough because rent does not support the value, and that's just that's just kind of in my area. That's just hard. One thing I should have said at the beginning is a rule of thumb that everybody says is the 1% rule, which I've said a bunch, but at a very baseline level, you want to try and get the property rent to be 1% of the purchase price. So like, let's say you were buying this place for 300,000 already fixed up, you'd want it to rent for $3,000. And obviously a 2-bed, 1-bath in my area is not going to rent for $3,000. So it's kind of just area dependent, but that's a baseline rule of thumb.
yeah. And what would this look like if we flipped it? Because if we analyze this and we got to this point, this isn't a deal that we would look to do. We would say, like a BRRRR, I'm okay with like $100 to $200 in cash flow. Like even if it's not a ton of money, like because you just repaired everything and you're not probably going to have the capex expenses again. So because of that, I'm okay with like $100 to $200 in a BRRRR deal. Like I got 25 grand back in my pocket, plus I get $100 a month. I have another property under my belt. That's a win for me. Um, some people might want a little bit more cash flow, but that's I think how Ty and I feel about a BRRRR. But I'm not looking to take negative cash flow, at least in this scenario. Um, negative a couple $100, yeah, is not really going to be worth it.
BRRRRs purposely don't cash flow a lot because you're pulling out a lot of money. So the idea is you get them for really cheap and you can get 10 instead of 2. And so 10 that cash flow at $200 is a lot better than 2 that cash flow at $500 each. But yeah, you're right. So like you want to find different exit strategies. And in this case, well, renting it doesn't really make sense. So here's the little quick flip calculator. And so gross profit, that's basically the same thing as equity created. Like we spent 175, 220, 235 total. Plus the hard money cost. So we're subtracting that from our profit. We're going to subtract 6% for realtor fees, and that leaves us with 34,000. And then let's just say you're paying $25,000 or 25% in taxes. We'd be left over with 25,000. And honestly, that would be amazing. That's a 52% ROI. So in this scenario, this probably makes more sense for a flip.
Yeah, and that's what makes this calculator so great is we can, we would love BRRRRs. BRRRRs are harder to come by in today's market with the higher interest rates, and so we can look at a property and say, you know what, it doesn't make sense for a BRRRR. We can try to flip it.
Yeah. Yeah, and just like to prove a point, let's say that this was a 4-bedroom and we could get 2,600 for a 4-bedroom. And we're going back to the 75% loan to value. So again, this one without property management is going to cash flow us $210 a month, and we're only going to have left in 32,000, which is not great, but you know, it's something worth pursuing. And then you could, again, you want to work backwards and say, like, okay, I don't want to leave in 32,000, so I'm only going to offer 160. Okay, now you're only leaving in 16,000. Now I would pay 16,000 to get $210 in cash flow all day. Right? So then I offer 160. All right, so that's pretty much how we would analyze a BRRRR. Now we're going to move on to more of just a traditional put down 20%, 25%, like a long-term property doesn't need work.
Yeah, this is a little bit easier to
Yeah.
purchase because you're not going to have as many renovations. There's less things that can go wrong because you're not doing any construction to a property, repairs to the property. Can't get hit with like too many surprises. You know, you're going to do an inspection and make sure the property is in good shape. So you shouldn't have like a roof repair or something else that's kind of unforeseen. You can always run into that, but when you try to buy a property that's currently rented, you're usually not looking for a ton of renovations.
Oh, yeah, there's a lot less that goes into this. Like you don't need to look up comps that recently sold because you're not going to do a refinance. You do need to look up rental comps, and we'll do that. Oh boy. So this is the property I chose. I don't know a ton about Lancaster, but I know that they have a lot of multifamily. So again, I'm assuming it's a fort or a 2-bed, 1-bath each side, but 2,700 square feet's a pretty good amount. It has a solid yard, colored covered porch.
This looks like a primary for you and Danielle.
And it honestly looks like it doesn't. I mean, again, there's not a lot of pictures. You might have to repaint this, but the floors look decent. Um,
Yeah, it looks like they kept the original hardwood, which is everybody's favorite. Everybody loves a original hardwood floor.
yeah, and then when I'm looking at multifamily, one thing I always look for right away is how many electrical units does it have? And this one looks like it has 4, which is interesting. Uh,
Does it say in the description it's like a 4 bed, 4 bath?
it just says 2 units. So let's see. 2-bed to potential 3rd unit. Third unit is reapproved by township and hook up to public
So I'm
water.
wondering
Okay.
if it was in the basement or something, and they said that he couldn't rent it out anymore.
Yeah, I'm gonna go ahead and run the numbers without that 3rd unit because we're not gonna do any renovations. However, these are the types of things that can make you a lot of money if you do convert it. I've never done that, but again, looking at the facts, public and well. Well does not concern me nearly as much as septic. Wells are fairly cheap to have work done on them. Septic is like a whole nother beast. So it was built in 1864, which is a little concerning. But
It looks like it's still in pretty good shape, though.
sorry, say that again.
It looked like it was still in pretty good shape. Like the outside structure looked pretty decent.
Yeah, I mean, again, we're kind of assuming that we're not going to do any renovations. Now, you might always have to do like paint 5 to 10,000, but so for this, we're going to use a different calculator just because I like it better for long-term rent. Um, We did get this from our networking group. But so for this one, let's say purchase price
To the
425.
wealth juice.
Yep, percent down. So again, if you're buying just a straight up investment property, most places are gonna require 25% down. You can
I
find
think
20%.
you can get 20% down for an investment purchase first time.
Yeah.
It's the refis that are 25%.
And then closing costs, we're gonna do a little bit more because it's um more expensive. I've never bought in Lancaster. Closing costs is also area dependent. Um
Maybe 10
okay,
grand
and
in initial improvements just for like paint and small little touch ups.
yep. Okay, so now you're gonna want to go back and do the same thing, looking for rental comps. Now, there's a ton in Lancaster, so you do want to, cities can be very like uh, street by street, so you do want to kind of try and stay close. This looks like it's outside the city, Millport Road. So there's not a ton. $13. These all look like condos. I guess here's like a single family in pretty good shape, or that is a townhouse. Now, again, in this one, we're not doing renovation, so I'd say this one is probably in better shape than ours is going to be after we do the, you know, small amount of paint and stuff like that. Like our kitchen's not going to look like that.
I'd
So
say
these I'm gonna,
1500 is probably more
yeah,
accurate.
yeah, I would agree. And I mean, if you're not getting like any hits at all, like you can obviously adjust, but like you don't necessarily want to compare it to a 3-bed. I mean, here's a 3-bed, 2.5 bath. We're obviously nowhere near that.
Yeah, I think we can just use the like 1400 or something.
Yeah, and they're both 2-bed, 1 bath. Okay. So here this has an option for multiple units. So we'll say 2-1, 2-1. Get rid of this. And again, I can tell you right away that based on the 1% rule, this property is going to get you 2,800 in rent, meaning you're going to want to pay like 280, and it's listed at 425. So it's not going to work at 425. I'll tell you that. And then you go down. Let's see, property taxes. So a lot of the times you can find the property taxes on here. That's 6,000, but that's at 268. Here it has. All right, we're gonna say 6,000. Insurance. This is a month. Say 150. And then depending on how you set up your leases, we try and not pay any utilities. Um, and then again, we're gonna manage this ourselves, and we'll go 5% vacancy and 10% maintenance. Now that's capex and like smaller maintenance.
Yeah. And with
That's
just
pretty
buying
much
it
all
like
I've bought.
existing, there's a bigger chance of us having repairs that are going to need to get done.
Yeah, so then all this stuff's filled in, and I'm really just looking right here. So again, you're losing $647 a month, which is not good, obviously. You're gonna lose almost $8,000 a year, and you spent, let's see, I mean 100,000. Your down payment's 85, and your closing cost is 115, and then you put in another 10. So you spend 110,000 on this deal, right? It's not gonna work. But go into every property and say, okay, what will make it work? And there's obviously purchase price is huge. So I mean, I would probably offer like even okay, that still doesn't work, right? But now this property had that interesting thing about the third unit. So let's play with that. Let's say it's a one bed, one bath.
I
Now,
think
what
he
did
put
it?
in the notes he listed it for like 700. Did I read that right? No, 720 square feet.
Third unit, one bed and finished. Let's say 1,000.
Yeah, that's fine.
But let's bump up our initial improvements a little bit to 20,000, assuming that you're gonna have to pay the city to get it rezoned. And well, he did hook up public water, but obviously the water's already coming to the house, so I don't
I
know.
think they probably disconnected it though to that third unit.
Right. Let's say 25,000. So if you do convert this, now you're at, and you get it for 350. Again, I think I always want to think this, but I think this will sit for a while at 425, and then I'll be surprised someone will buy it for 425. But who knows?
It's unique with some of these properties. Like to your point, the number one rule that we hear about is the 1% rule, and so there's so many like I don't know. I don't know how to justify the people that list their property for sale and then they have to know that that's what people want, right? Like it's not going to cash flow. Like at what point does this deal make sense? You have to put like 40 grand into the property. You know what I mean?
Yeah, I mean, 1% rule is, I feel like more for if you're getting a loan. And this actually shows you here, 1% rule fail, even at 350 with the third unit. But like, let's say somebody's just buying it cash, like they might buy it cash for 400, make 4 grand a month and be happy with that, because that's still like a 10% return. And honestly, a lot of investors are buying places cash like that. There's a lot of people out there with a lot of money that buy houses cash. I feel like I still don't realize how many people, you know.
Yeah, and I think I said 40,000. I meant 40%. So like some people might put 40 to 50% down to your point. So they have a loan, but it's for significantly less and they are still making, some sort of cash flow on that money. That's a way to make it work. So I guess there's those scenarios as well. And like this is Lancaster, which is a very desirable area, and that probably adds to why this property is priced a little bit higher.
Yeah, and some people are buying for appreciation, where like they'll buy this place 425, let's say cash. They're not going to make a ton of money per month, but they might sell it for 500 in 2 years, or 700 in 10 years, or whatever, depends on how much an area appreciates. But the whole point of this is showing that you want to figure out what number works for you. Um, Again, if you're going into this, if you're planning on doing the third unit, which is a possibility, and again, that's ways you can make a lot of money in real estate, is to be creative like that. This property could work, but you got to get it for pretty significant under, let's say 375. So at 375, I mean, you're still going to cash flow $500 a month, but you put in like almost 130 grand at this point, which if you look at ROI, that's 5%. That's just not good. You can invest in the market. So
Yeah. No, I think that was a pretty. I mean, unfortunately, we just picked two deals and that we saw in the market this morning and ran through them. Like in a perfect world, we'd love to show a deal that works, but if we did that, we'd probably be putting an offer in on them, and this is why it's not as easy. Granted, Ty and I have been pretty busy. We haven't been searching for deals. Maybe Ty's kind of primarily focused on finding his primary property, and that's where a lot of his attention's going. I've been looking, but I usually look in the next 4 to 5 months to buy something up around Misericordia because I don't love getting properties now that I can't get rented out until the following year for school. So it's been a little bit slow on my end as well. But if we find a property that does make sense, we're definitely going to try and put an offer in. But this is a lot more what we're seeing in today's market with the higher interest rates is that properties just aren't cash flowing. They're not making sense for a BRRRR. We haven't necessarily done a flip yet. We want to. We talk about doing flips. I think there's still an element of being scared to do a flip for both of us just because everybody talks about how hard flipping is, how strenuous it is, and like how much unexpected issues can come up and like can kind of eat into the money that you were supposed to make. Like say we bought the deal we showed today to do a flip, we're going to make $30,000, but let's say the roof needed to be done and we didn't account for that, and now that's 15,000, eating into that, and you only make 15. Not to scare everybody, but it's just something that we've been kind of nervous about. I think we'll do a flip here in the future. And right now, flipping seems to be the number one thing that makes sense with how high interest rates are. And it's like you can go in with the plan to flip and then fail, and it's okay. And maybe you just treat it as a BRRRR. And so hopefully it's not the scenario we showed earlier where it's only, you're negative $800 a month in cash flow. Hopefully it's closer to like $100 or maybe negative $200. But if you're negative $200, it's not terrible. You can get it rented out for, a long period of time until the market gets right again, and then you can, sell it.
Yeah, exactly. I mean, you want to have multiple exit strategies. So like we looked at that property as a BRRRR. I'm not interested at a BRRRR, so let's look at a flip. And the flip numbers actually made sense if it sells for 300. So I mean, I'm actually a little interested in the property, especially being a foreclosure. I don't know. But yeah, the whole point of this exercise, obviously, to teach people how to run the numbers, but also I just want to stress, like, again, it's not about the list price. Doing this is helping you figure out what you need to get the property for, and it doesn't matter if it's 100 grand under list, right? Like, put the offer in. It might take you 100 offers to get one accepted, and it seems crazy. Like you're like, who's gonna accept 100 grand under list? And it's just like you never know. Especially the longer it's been on the market, the more likely they're going to come down in price. So
Yeah, I think a lot of leverage is happening right now for buyers because certain properties have been on the market for a while. Like to your point, some of the houses that you really like the houses that are, you know, pretty much move-in ready, they're having a lot more competition, a lot more difficulty maybe getting a good deal. But the houses that have been sitting for 3, 6, 9, 12 months, like those are the properties that there's got to be some flexibility because there's, you can only say, hey, I don't need that 300 grand that's sitting in this property until I sell it. You can only say that for so long until you're like, you know what? I'll take 250. I'll take 200 because I'm done waiting. So I think that you're going to see some of these properties selling for a little bit less.
hopefully, but we'll
Yeah,
see.
hopefully. I found a quote here. It says, "You don't make money when you sell, you make it when you buy, and that starts with the right analysis." And I think that's exactly what Ty's saying is you have to buy the property and kind of work backwards to make sure you're buying it at a great price that's going to, overall make you money later on when you do decide to sell it. But you have to get it for a good price that makes sense today.
Yeah. Yeah, I think that's a perfect thing to close on. So yeah, if you have any questions about the spreadsheets, or I could send out my Excel sheet. I'm not going to send out the other one, but yeah, hit us up if you have questions about it.
All right. Thanks for tuning in.
Yep, see you next week.